And then there was light. Good afternoon, everyone. Welcome to this roundtable, which is happening at a rather special moment in the afternoon. And we made a deal earlier on. We agreed that we would do everything in our power to make sure that you would stay awake on quite a very interesting topic, international programs in the light of local regulation. So it is my great pleasure to welcome top experts, each recognized in their field, and they will share with you their own vision. And hopefully following this roundtable, you will know more about the latest developments and how to adopt these latest developments. Now, in alphabetical order, excuse me, madam, in alphabetical order, I am joined by Abdelhadi El Omari from AXA Afrique Atlantique. You're very welcome. Thank you so much for being here. Claire Hamonique, General Manager at Ascom International. Thank you so much, Claire, for being here. And Denir Roca, partner at the car consultancy and a partner at Holman, so from Brazil. So thank you so much, sir, for being here. Let me set the context by sharing a belief of mine, and this I am saying from the standpoint of Africa. It's been close to 10 years that I have looked into international programs within the Globus. We can see pretty much 3,000 international programs every year, and for the past 10 years there's been a key trend. Regulations are on the rise. There are more and more new regulations, and there are two key aspects here. First of all, the regulatory constraints that entails, but also the banking constraints. From a regulatory standpoint, regulators in various areas, whether it be in Africa, in the CEMA area, French-speaking Africa mainly, but also in Western Africa, there are more and more there is that growing determination to protect local capacities. So deplete your local resources before you outsource anything. Moreover, in Africa, there have been more and more reinsurance companies being established, again with that determination to keep things local. And if you listen to the new president of the African Development Bank, he said that there was a need to approve a $400 billion budget for new schools, and so reinsurance has a role to play in this. And the CEO of Africa, during the Africa CEO Summit, he said something that was really interesting. He considered insurance premiums and reinsurance premiums as an economic infrastructure. There you have it. So once you have that context in mind, that gives you an interesting light on the topic. Claire, I would like to turn to you right away. In your opinion, when we speak about international programs, what are we referring to exactly? How would you define an international program? Well, I will not try to give a lengthy definition. An international program corresponds to a unified insurance policy with a mother policy and local policies. In doing so, you're looking to be consistent in the guarantees offered to all subsidiaries. And second, you'll try to benefit from a virtuous effect on prices, because you have that pooling effect allowing you to get better fees. And then, third, and as much as that is possible, you're looking to have the same contract architecture. These international programs as they exist in Africa have changed greatly, and that's something we wanted to address with you today. Indeed, for the past 30 years, regulations have completely changed in Africa, and that changing process is still ongoing. 30 years ago, it would have been rather easy, or plain easy, to implement these kinds of policies with a master policy, because regulations were quite similar, but now it's completely different.
Now it's no longer the case. There have been major changes in all areas in the last 15 years. Others are yet to come. We were talking about it yesterday with Serge, and we'll allow ourselves to share our thinking today. But there are major changes that we wanted to highlight. Yes, absolutely. The key word now is complexity. And why is it more and more complex in international programs, given the regulatory changes that we're seeing on the continent? What I'm saying for Africa also applies to Latin America, and Denir will tell us more about that. Abdelhadi, could you tell us now why it's more and more complex? What are you seeing about these regulatory changes and the impact that that has on international placements? Thank you, Serge. Good afternoon, everybody. I'm delighted to be here, and thanks for inviting me. Before I start talking about the CIMA aspect, I wanted to talk about Morocco first, because as you probably know, my scope is Morocco and CIMA. AXA Africa Atlantic is Morocco and CIMA countries. The regulatory constraints in Morocco on international programs has to do with a single clause, which is the cash deposit, which is required when you work directly from Morocco with the international reinsurance market. So all facultative reinsurance placements go through Atlantic Re, that is the national reinsurer. So Atlantic Re is the reinsurer for Moroccan insurers, and then it retrocedes on the international market. It's the only constraint by regulations in Morocco. Yet in CIMA, things are very complicated because there are different areas. There's the branch area, because you have branches with targets of 100%, like hulls and marine TPL. Some can be ceded at 50%, like damage and everything that has to do with fire, and then branches that cannot be ceded at all, such as cargo transport. To that, you should add legal cessions. And regarding that, there are different types of mandatory disposals. There are some for first time, and others when you place with facultative reinsurance or with treaty re. And then you have some with regional reinsurers and others. On top of that, there is legal cessions to local reinsurers, like in Gabon with CGRA, and also Senegal with Senri. On top of that, now we have a similar thing in Cameroon. So we have a host of mandatory disposals that we need to comply with. That makes international programs very complex to build, and we are losing all the benefits that we've built over years to try and have global cover with a simple process where all operators, you only have a handful of operators. Now we have dozens of operators, so that makes everything very complex.
Yeah. Are you observing the same complexity in your region, especially in Brazil?
Thanks, Serge. Thanks for your audience, and Claire and Abdelhadi. Brazil and other Latin American countries, they are non-admitted It means they protect the local market. As you said, in Africa is the same as in Latin America. So it's possible to purchase insurance from abroad, but it's rather bureaucratic. For example, you must have 10 denials of insurance companies refusing the coverage. Then you apply for our regulator, and then the regulator issues the authorization. Then you can buy insurance abroad. And it takes the whole process so cumbersome. What happens? In Brazil, it's possible to have policies with international programs, provided the insurance company located in the master policy, country of the master policy, this insurance company cannot send payments to Brazil. So what they do, they send indemnification, they pay indemnifications in the country of the master policy is located. And basically, this is the way that this kind of insurance programs is used in Brazil. All the thing to pay attention is our regulator has never refused to to approve an insurance policy with the clause of international programs. So it's possible to use policies of international programs, but it's not possible for an foreign insurance company to pay indemnification directly to the subsidiary in Brazil.
Thank you, Dinia. Je me retourne vers toi.
Turning to you again, Claire, as a broker, how do you currently absorb all these various changes as part of international program placements? First and foremost, it's a communication problem. Everybody's talking about communication. We talk a lot about it, but we don't really do it. So communication is about highlighting the differences between the country in which you're going to work and the starting country. That might be just a detail, but in Africa, since that's my preferred scope, my only one, actually, in Africa, there are a number of countries where, one, premium rates are regulated. That doesn't exist in Europe. Secondly, that's not the only thing, commissions. That's very important for a broker. As we know, commissions are also regulated with minimums and maximums set by the regulatory authorities. More and more in Europe now we can see contracts that are issued with zero commissions, saying you'll be paid as specific legal fees. That we can't have that. And also, there's the issue of settlement of premiums. In Europe, we still have the old system that lasted until 10, 15 years ago in Europe. Now it's pay cash before cover. So very concretely, as long as the premium is not paid in full, because transport insurance here is not one of the exceptions that can get the regulatory 60-day facility. So as long as cover is not fully paid, you don't get guarantees. So it's very important to say that and repeat it again and again. And it's also very important to help different players meet when they were not used to speaking to each other before. I see that every day. I'm speaking about the master insurer and the local insurer. At Ascoma, very regularly I meet people who tell me 3 or 4 days before, well, you need to implement policy in 3 days' time immediately right now. Of course, you need to send me the certificate and you'll get, in fact, a little premium kickback from the local insurance of $5,000 if everything goes well, and you get a fee of about $1,000. But let's be serious here. I mean, we need to be compensated properly, and you can't just do any and everything. So it's always the same problem. We need to communicate. That's what I'm always telling my people. If you know me, you know it. If you're talking about a given country, you'll immediately have a full X-ray of the country, what you can do, what you cannot do, what are the lead times that you have to follow, and also with the legal text to match that, because I need to evidence it. And then there's the issue of insurers' capacity. We all know that in Africa, insurers don't have the same capacity as a French insurer. If you tell a French insurer that, well, I need a charter or TPL with 1 million euros cover, that won't be a problem. In Africa, in 80% of cases, local insurers don't even have the capacity to do so. This means that you'll need to use reinsurance. And that reinsurance initially was relatively easy. It was zero in some cases. Then in all other business lines, it was 25%. And for the last 13 years, everything has blown up entirely. Coming back to the matter of interest for all of us here for marine insurance, external reinsurance is not allowed for the cargo line. For the whole line, it is allowed, and that's lucky because local capacity is not looking very good. So concretely, that also means that working with an insurer is a good thing, but you need to also work with a reinsurer. Still on that complexity matter, what is also important to perceive is that, and these are local realities more and more, that's not just in French-speaking Africa or CIMA. I'll take the example of Kenya or Ghana. The regulator will look more and more at the local rates and also at the wording. We had situations where, and that's also another issue and challenge, they want us to use up all local capacity before ceding abroad. The latest country to date is Gabon. Gabon didn't invent it. It has existed for a while in Rwanda, ditto in Kenya. But what is complex is not so much the regulatory change, but the fact that the change in regulation happens when we've already had a renewal, and so it will apply retroactively. Since it applies retroactively, that will be a problem in placing the international program, because we'll need to go back to the master program to say that, well, we had agreed those conditions, but here we'll need to revise them. And so for the broker or the international insurer, they will need to convince the risk manager again, from the client, which is not easy. That's a reality. That's what we can see. In the case of Gabon, it was very recent. It was at the beginning of this year that we saw this happen there. So we need to take that into consideration. These are elements of complexity. Well, we may not talk about that enough, but these are realities on the ground. These are constraints that have impacts on currency transfers. Imagine that you've got a master policy and a local policy with a premium share that will apply locally, or depending on your scheme, you will need to retrocede premiums internationally. And here that doesn't depend on the bank or the company or the local fronter. It depends on the central bank that will, from which you need to get authorizations. And these authorizations will determine the availability of currency in the area. We can see that a lot, and it's much worse in the BEAC area. And in the WAIMU area, it does exist, but it's not as draconian as is the case in the BEAC area. I'm talking about Cameroon, Gabon, Central African Republic, all the Central African countries. And that creates problems locally. Those are constraints that our markets are facing. Once you've understood that, what should you do? The second part of our discussion, what should you do? What should you change? What should you change now? Are we still going to say, well, these are regulations, well, we'll do without it, but are we going to convince the regulators to change? My personal perspective is that it's impossible. This is a direction which is followed, and it's only going to get worse. There's no going back. Why am I saying that? Because you've got the flip side of that, which is what people don't know, is that regulators demand a minimum of equity from local insurance companies. So that means a lot more capex, and that's why they also have local regulatory retention obligations. So Claire talked about communication. What we should do, I would say that we need a lot of awareness raising. We need to get that on board and think that these regulatory changes are not here to make business more complex. You should consider now, and I'm talking about Africa here, this is now a new market, a regulated professional market, a market which is going to grow. Now the penetration rate is 3% of GDP in Africa. So that shows that the room for progress is huge, and that's only going to grow. So we need to take these regulatory changes on board in our international placements. So turning back to Denir.
What do we need to change? Any change?
We have many changes in Brazil. Brazil is quite emotional, like the last match of World Cup. So we have a new insurance law enacted last year, and this new law brought a lot of different things. For example, the insurers, they have 30 days to adjust the claim, and they can request only once the documents and information. If they don't do it, they lose the right to deny the claim in the future. For personal lines, the large risks, this term is 120, and there were changes in basically everything, the statutes of limitation, there is a taxed acceptance of reinsurance. For example, if the reinsurer, once they receive the proposal, the reinsurer must issue they deny the risk or accept the risk within 20 days. If they don't do it, there is a tax acceptance of the reinsurance. So it's important to combine and to understand the local laws. That's why, in my opinion, you must have good partners, good brokers, good reinsurers, and good insurance that understand locally and globally as well.
Thank you, Denir.
Abdelhadi, what do we need to change? To me, we are observing a phenomenon that is getting heightened now. We can see international program cover that has already come into force, but cover is not yet granted on the local market. And that's something we saw because we know full well that the regulatory impact on some countries is colossal. So what you need to do is that there are a number of points of attention that you need to anticipate on during the negotiation phase. We need to include a number of items. The first one is the choice of local insurers, because it's very important for some markets. There are solvency issues. Secondly, you need to approve the regional and national reinsurers on the security list, because we have clients that are very demanding. They don't want to hear anything. They want secure reinsurers, so we need to approve them immediately and get the client to understand the regulatory constraints. Then there's regulatory compliance with the whole local setup, because we understand that there are local holding requirements that need to be included in the wording of the international program. And then there's negotiation on fronting costs that we tend to forget, and we detect that when we go on the local market. So fronting fees are required by national and international reinsurers. And last but not least, sometimes you've got the master policy in English and they ask you to issue a local policy in French. That's a real headache. So all that, will work on that very far upstream before the international program comes into force, because as Claire said, the client wants to have a certificate. They only want the final effect. And so there are some international programs that have started and taken effect, and so all they care about is the certificate. Claire, what should you do? You need to be very careful about the insurers you're working with. We've all said it, you all know that. Africa has changed. with stricter regulations, with a very strong desire to let insurance and now reinsurance premiums to keep them in part in the country, and that's not going to stop. That's okay, that's one thing. But if, besides that, there had been some upskilling for local insurers, that would be very good. But we only have to admit that it's not the case. I'm sorry to say that, but there are a lot of operators on the insurance market, a lot of insurers that do not deserve that name. At Ascoma, when I arrived, the first thing we did was to create a placement committee that reminded me of a previous life. We did that for reinsurers, and we did that with insurers with a list. There's the top, the middle, and the bottom. And we monitor the application of the list very strictly. We need to prefer insurers with which we work regularly. We need to work with networks, whether they're integrated or not, but that's not the issue. Of course, if you've got a local insurer that does anything, and they've got an agreement with a master insurer in Europe that says, okay, guy, you'll pay for that loss, okay, if you don't issue documents within 6 months, I'll find another local insurer. That will force them to get a move on. And so it's first and foremost about communication. That's what I was saying. And secondly, you need to select your partners. Thank you, Claire. Indeed, what should you change? Well, I said that earlier. The goal is not to say that we're going to change regulations. We need to change the way we work. Indeed, I think that nobody here in the room wants to take risk. So, of course, we need to work. Well, nobody wants to take risk to put our customers and clients at risk. So we need to work with partners that don't want to put themselves into peril. Because, as I said, African companies are regularly scrutinized by regulators. Our regulators are very strict, and be careful about players that say anything is possible. You need to work with players that are able to say, well, this is feasible, we can find a solution, but that remain fully compliant. So the key word here is compliant. We need to find compliant solutions. And at Globus, what we do is that we train all of them. We train all of our partners from the moment there is just a rumor about regulatory changes in a given country. We train our partners. It's important to be up to date and informed. We need to fish around for information. Whether we are players in France, the UK, or anywhere, brokers, insurers, we already need to know what we're talking about. Abdelhadi wanted to... Well, he didn't have enough time. He would have had to give you a full catalogue of regulatory changes with the legal articles. We know it's a very big thing, but we don't have enough time to give you details. But it does exist. And there are trustworthy people on the market who can give you the right information, so that when we're all on the same page in terms of information, then we can make a decision. But we should all take into consideration the fact that the African market now is changing and becoming more professional. It's going to become even more professional with more and more credible operators, with governments that are going to be more and more full-fledged players, regulators that are going to demand more and more that risks remain local, because the challenge for governments is to consider that insurance premiums and reinsurance premiums are premiums that are issued locally. And if you say that to an international program risk manager who's decided that if you tell them that the premium share that belongs to Africa should stay in Africa, they'll say no. But if the regulator says, well, the locally issued premiums are part of the local economy, so we need to be able to make the two meet. I can see Cécile. No, I was thinking we have a little time for questions for all four of you. So have you got any questions on these technical but very interesting matters? Yes.
So, I'd like your opinion. You mentioned it's not possible, it's not allowed to purchase insurance abroad. Okay, I agree with you, but I have seen many cases wherein the insured is, for instance, the Chinese exporter, and the beneficiary of the insurance is the Brazilian consignee. Then the foreign insurer will pay the claim to the Brazilian consignee in Brazil. What's your opinion about this scheme? Is that o jeitinho brasileiro?
For this transaction you mentioned, there must be a prior authorization. Otherwise, the indemnification paid in Brazil may be taxed. And if there is no authorization, it's an infraction of the legal rules in Brazil, and it may lead even to a criminal proceeding. So it's very risky operation, but I know that some companies, they do this, but it's not legal.
Il y a combien de minutes encore?
On a le temps de prendre encore.
We've got time for another 3 questions. All right. The lady at the back. Good afternoon. You talked about the implementation of local policies for local insured. Could we have a few words about the use of CIF Incoterms, both for sales that are made by non-Brazilian players with Brazilian buyers, for instance, or non-African sellers for African consignees? Are you asking one person in particular around the table? Okay, who will dare have a go? We've got Incoterm specialists. Well, I'll start. So, CIF, well, that's the case now. We know that you'll have a kind of master policy that will be all risk, and then a local policy that will be FAP, and well, that's traditional. This FAP is used more to comply with customs declarations requirements when the goods exit the territory, but I think that changes are about to happen, because that very small part that is only FAP, although now FPA, although that complies with the schemes and regulations, but with bigger and bigger risk retention and domiciliation obligations, governments have observed, and as Claire was saying earlier, when the share allocated to local policies is much and completely smaller than the capital insured, well, if you've got FPA locally of 0.15 or 0.2 in the CIMA area for such risks, whereas on the all risk part, you're going to have a situation where they'll compare, and they said you only took FPA locally, whereas the risk, main risk is insured elsewhere, so you're not complying with regulations. That's something that might change. So if this is a CIF sale, you might think that the beneficiary is the importer. And so the importer might tell you, well, tomorrow, if I'm the importer and the beneficiary of the insurance, maybe I'll rather work on my insurance program with local players, have all risk that will also cover the local part without needing to have FPA locally on top of that. I thought that there was another question over there, but it seems there are no more. Is there a question from the other auditorium? If we can... There was a hand raised over there. Madam here. No, eventually no, they hesitated. In the other auditorium, no. And last question before we wrap this up. Well, it's time to wrap it up. Oh, I'm sorry, over there at the top. Thank you for this talk. Indeed, it's something that I'm very careful about, and I'm directly impacted. Generally speaking, on the cargo line, you've got an insured, well, for the French market, they're French. The insurer is French as well. And the beneficiary on the case of imports to a CIMA country, the beneficiary will be subject to CIMA regulation. And the applicable law to the insurance policy is French law. The law applicable to the seller is also French law. And so how can local constraints can interfere with these Franco-French matters? That's the last question, but a trick one. No, not at all. That's legislation that needs to apply. There's the relative effect of contracts, we all know that. But in that case at hand, we have to, and it's provided for in a lot of master contracts, we have to follow the legislation of the destination country. And so what matters is the domiciliation of the beneficiary. That's what they'll tell you. So buyer, seller, okay, but the criterion is where are the goods going to arrive effectively? And from the local standpoint, the regulators will say, well, the goods are coming to my country, and if something happens, you know, we had a lot of losses, issues with rice in some countries and contamination problems. So if the goods are damaged when they arrive, my country is impacted, and from that perspective, they'll tell you that the domiciliation of risk requires that you look at things from that perspective. Now, that being said, there are solutions. Everything we've tried to say here is that we now need to take on board the fact that we're not doing things the way we used to. Claire said 30 years ago, when we needed to put a program in place, we thought, well, we won't even worry about the destination, the place of destination. But now, if you have a destination, you need to imagine that there will be local regulations that will apply. And how can you reconcile that with the international program, the master policy, with the local policy? Are you still going to consider that these are two distinct policies, the master on the one hand and the local one on the other? Or might you consider that they are fully integrated? I'm in favor of option 2 that says that they should be integrated. You need to consider that the master policy and the local policy are part of a whole. And so both the master insurer, the local insurer, are all part of the same endeavor. So that's the message that I think we wanted to convey, and we all agree on that, because that's the current reality. And if you don't take that reality on board, well, unfortunately, you're going to end up well, when I'm talking about sanctions, if you got local insurers, well, Abdelhadi is in a better position than me to say, but when the CIMA regulator comes to your office to inspect you, no insurer is happy about that. And if they pull all of your books and realize that you're doing business that contradicts regulations, well, your license is at stake.
Voilà. Cécile, apparemment, il y a encore une main qui...
There seems to be one last question. Shall we move on to the conclusion? Well, actually, I think now is the time to conclude. Someone was raising their hand. Well, if they raise their hand high enough, I guess. One quick question and quick answer, please. Yes, of course. A quick comment. Selling contracts and insurance contracts are three-party contracts. You have the source country, but also the destination country, and they can lead to autonomous legislation. The legislation you focused on, if this is depending on the public order, I think that the law of transportation of the country will apply. Okay, thank you very much for your contribution, sir. Now is the time to conclude. And to do so, can you please, for 30 seconds each, tell me the following. Imagine you have a risk manager ahead of you. What should be their key program? Well, I would tell that risk manager to check upstream that they have the right elements required in their master policy and local policy, and require from your counterpart that they have all elements, and if needs be, to speak to the insurances concerned. And if there's any doubt there, then it means you might be in trouble.
Did you get the question?
Yeah.
Thank you.
My advice is to review very carefully the international program in the country of the subsidiary, because sometimes the policies, they don't talk to each other. As Claire said, it's very important. Communication is the key in this case. So, for example, times to notify the claim are different in both policies, and the way you notify is different as well. Sometimes it requests notification only in the master policy. They forget to notify in the local insurer. So the key information is the key in this case.
Thank you, Didier. Abdelali.
Pour moi, c'est simple, même s'il s'agit.
Well, for me, this is a complex issue, but the answer is quite simple, actually. In-depth knowledge of local markets, that would be number one. And number two, making sure that communication is happening between local stakeholders and international stakeholders to avoid any divergence. So there you have it, complex issue, but actually the answer can be rather simple. Thank you very much. Okay, so my answer would be, for Africa, Africa is not looking to have fewer international companies. It's only asking for a true partnership to be established between local stakeholders who will become more and more professionals, and there are major investors investing human capital and financial capital, significantly so, on the continent, and this will be a growing trend in the future. You have partners before you, and you can very much co-construct international programs that can satisfy both yourselves whilst being in full compliance with local regulations. Thank you very much, Serge. Thank you to the four of you.